Mom, I told you never to call me when I'm at work. Yeah, that won't work. Let's try this.
Okay, let's see if Firefox wants to play today. Yeah, thought so. Alrighty then. think this will work. Red light, gray morning, roll out, a hole in the ground, vampire, or a forex trader, depends on who's around. All right, almost done with all this nonsense. Everything that should be easy, of course, takes way too long. All right, well, let's get her over with then. Okay, great. So I went to play the YouTube video. That doesn't work today. Well, luckily, maybe that works on Internet Explorer, but the other things don't. So we're on Firefox today. Ooh, I made the coffee strong today. Snap. All right, well, I tried to get a full amount of sleep. I have a midterm tomorrow on game theory. So I'm looking really forward to that. I could find your Nash equilibrium in the dark. Uh-huh. Yeah, thanks. And then after that, I have another midterm. Ha ha ha! Hoo-ha! Anyways, hey, let's get going. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. My name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Please visit TradersWay.com to open up a trading account. I think you'll love our execution. I think our spreads are more than competitive, and we have excellent customer service. Just ask everyone. So I'll see you soon at TradersWay.com. I do these sessions 7:30 in the morning, a couple hours before the New York Open. It's also approximately London lunch. It's a good time as a community here at forex.today to realign our satellites. I also present the first Friday of the month at fxstreet.com, where I am the former Forex Speaker of the Year, but also former Best Forex Blog, former Best Educational Webinar, former Best Forex Special Event, former Best something else, I think. So it's cool. Been doing webinars there for 11 years, 12 years? I think 12 years. Anyways, who's counting, right? So nice to know you. I've been around, and I'm here to share. Jack up volume, please. Really? Maybe. Is it right? Because if that's the case, I'm worried that it's not using the right microphone. Maybe Hans, right? Hans, maybe if you stand on your tippy toes. Right? Maybe if you stand on your tippy toes, you'll hear better. Have you guys ever seen The Life of Brian? Where there's people way down at the bottom of the hill listening to Jesus talk? It's really funny. Blessed are the cheesemakers. Right? Who'd he say would inherit the earth? The Greek. Oh, blimey, the bloody Greek again. Because they can't quite hear what he's saying. Yeah, I think that's pretty funny. Look, even if you're the most pious religious person on the planet, it's still pretty funny. Yeah. Anyways, all right. So where are we? All right. Let me turn my overhead light on. Yepper. All right. So guess what? Huge shock. We have gone from support to resistance on the beast. We still have not broken resistance, which is another, which is another indication that it could possibly roll over and head back to support. It's a range, isn't it? The bottom currently is weekly M2, monthly M2. That'd be really hopeful if we were trending. But this support and resistance goes back like 3 weeks, I believe. Right? So nothing new. Bear in mind, it has two nicknames. One nickname is the Beast. The second one is the Widowmaker. So be careful. Okay. Yellow area here on oil is support. This old area is still in play, isn't it? If it could keep working its way bullish, it's going to go back to $50.87.5. Yeah, this part bothers me. The mic has to be right on my mouth. It sucks. Yeah, it's good for you. It sucks for me. This is $1,000 mic, get Daniel. Oh, it's not 1,000. Yeah, I guess so. Anyways, yeah, and of course the other part of it is it blocks out background noise so much I can't hear myself talk, so I sound like I'm deaf. But anyways, so we're at support, yo. Last week it was supposed to go up or down, and it did neither. Angled separation between the 2155 is diminishing. I'm sure you could draw the MACD. MACD would be going closer and closer to the waterline, but is indeed moving up. It crossed a little bit for a while. So if you were to draw the MACD, okay, let's make a MACD. Here's the top of the MACD. Oh, come on. Okay, here's the top of the MACD. Here's the water line. Here's the bottom of the MACD. And MACD currently is doing this. Let's see. It was heading down. And then crossed up. And crossed down. And then crossed up. And we're like that right now. That's what the MACD would look like if there was a MACD on this chart. Insert indicators, custom. There it is. Wait, what? It's like the worst MACD indicator ever. All right, let's try another one. I don't even know where it is on this stupid thing. I thought the one that came with MT4 was stupid. Maybe it's been updated. Somehow I doubt it. Yeah, just as bad. Who would want a one-line MACD? It's strange. Anyways, we'll leave it for some other time. You'll have to trust me, I'm right. All right. So, right, what do you want to do with it? It's your call. There's a lot of talk about OPEC, 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 whatever. So do what you got to do, boy. If you think it's going to go up, buy it. If you think it's going to go down, don't sell it here. Kitty cat. Weekly trade plan. The most aggressive one would be to kick it off the weekly central, which means you're targeting S2 at 131.50. However, that hasn't quite happened yet, because it could come down, and here, M2 would predict M4 up here. So depends on what you want to do. Why do I have a yellow area there? Because of that. Okay, because of that. Because of that. Cluster of pivots, both weekly and monthly. Why not? Well, for that to happen, you'd need Canadian dollar weakness and or US dollar strength. Okay, this indicates additional US dollar weakness. Nice little roll reversal. We're on the S2, however, huh? You notice that? That's supposed to be the bottom of the month. What do you want to do with it? You've just hit the bottom for the month. This is the first of the month. You guys remember? Let me zoom in. It's got to go to a 4 hour or something. This is the first day of the month. And if you sold there off the central pivot, the target was S2, which we have now hit. Is that cool? Don't you think that's cool, guys? This drop gives us this target. We've hit it now. I think fairly precisely, huh? Didn't wait very long to react. Louflet. So it must have been somebody's target, don't you think? What do you mean? 21 and 23. I'll follow you, Bill. Oh, yeah. I thought you were talking about this. What are you talking about? Gee whiz. Okay. I don't remember doing this, but it looks like I'm pretty adamant about the line in the sand. And it seems to be holding, huh? Interesting. Seems like that will be an interesting thing to break. That should be an interesting thing to break. And after that, free and clear plan for a while, huh? Got to get back above 80. Pretty nice. Here's the Aussie move. We're in there, sort of, huh? So when we drew this first triangle, it had just made the higher high off the FOMC news. So what do you think of the whole idea of that in of itself predicts a higher low, higher high. Okay. Still got to get past this stuff over here. That'd be a huge reversal going from monthly target to opposite monthly target. Oh, I went over the buy at 79, and the other one might have been a stop or something. That's cool. I don't think I was on it. I don't recognize it. This one is still developing, I think. Yeah, I did too. I did buy this at the M2, but you know, I bought it on a lower time frame, and then I looked at the upper time frame, and we're still below the 21 at that time, and I didn't feel very good about it, and I felt it was a bit early, so you know, I moved my stop close. And I think I fell in love with it on the Monday open, and then never got the follow through. I think I lost 33 pips. I could live with that, right? Yeah, Kareem, but that does change a lot because then you don't have the pivots. So that would, a leg down might be needed, but it would ruin my pivot swing trade. Oh, sure. Yeah. But, you know, like I said, I only risked 33. I didn't make 9 trades this week. So, you know, I got lots of dry powder. And what it might, right? And maybe it's next week's move, right? It's fine. And then maybe next week, if all that comes to confluence, then, you know, maybe I double the powder, shorten the fuse. Aye, aye, Captain. This little trickle down to the 21, that's sneaky. Never really got a pullback. This got to be careful of because it says rollover, doesn't it? I feel quiet today. I'm sorry. I don't know what it is. I have no reason to be exhausted. Just not in a, I'm just not in a mood, I guess. I don't know. Whew. Sorry. Must have been letting the dog outside at 4:45 in the morning for a pee. That could be it. But that's all right. I was in the shower by 5 anyway. So, I've told you guys over the years, part of being a trader is sometimes dealing with being married and kids and pets and all that kind of stuff. You have to do these things. There was a time in my life when I was newer to forex. I think I just quit my job and I just became a full-time forex trader. And I found myself up in the middle of the night a lot working. My wife would get upset, right? Because I'd turn on all the lights, walk around the house, make coffee, and all that kind of stuff. And so I ended up doing things like I had a headlamp, the camper's headlamp. Back then, they were rare. Now they sell them even at the dollar store. But it's a flashlight you put on your forehead. So I'd wake up, put my little miner's lamp on my head, and I'd find some clothes, put it on, and I walk around the house, and I make coffee, just walking around in the dark, put my headlamp on. And then you'd set alarms on your charts, and so that your cell phone would get text, and you sleep with your phone and all that kind of stuff. Well, one of the things I have now is a waterproof Bluetooth headset, something you could actually swim in and listen to music. Well, in this case, what I do when I'm up at 4 or 5 o'clock in the morning, I still meditate, and I still like to listen to like Bloomberg Radio or Bloomberg Television. And so, like this morning, it was 5 o'clock in the morning. Everybody's sleeping. I'm sitting in the shower, listening to Bloomberg Television, in the shower with my Bluetooth headset. Now, normally, I have a built-in Bluetooth speaker in my shower, so normally, if it was like 6 or 7, I'd have it on. But at 4 or 5 o'clock in the morning, or sometimes I'm up at 2 or 3 o'clock in the morning and I want to shower. Yeah, I put on my waterproof Bluetooth headset and I listen to the TV while I'm in the shower. Well, what you can do, Nick, is you put your tablet. So, of course, I have a glass shower. It's all glass. So, in that case, I lean it against the glass. And I got the Bluetooth sound coming out of the speaker, anyways, right? So, yeah, it's great though because the speaker in the shower is also a speakerphone, so you can do like conference calls naked. And they're like, "What's that sound in the background? Is it raining?" I'm like, no, it's the water in my shower. Like, well, why can I hear the water in the shower? Oh, because I'm taking a shower. Yeah. They're like, what? Like, I swear to you. They're like, hey, well, when can we do this conference call and stuff? And I'll say, and sometimes I'm typing, I'm like, well, as soon as I'm out of the shower. I'm like, when are you in the shower? Right now. I've actually done meetings where I'm typing in the chat while I'm in the shower. It's pretty funny. Hey, I don't like to waste the time. Yeah, it's just, well, I got things to do. Like, honestly, when I say I don't have enough time, like, why would I waste and I take long showers though too. So, but whatever. And that's no waste though, because a lot of it I'm meditating. So, and that is required. All right. So, anyways. Oh, Hans had a question about something about risk. Yeah. So the answer that Joe is alluding to is you reverse engineer your risk based on what you want your worst month to be. And hopefully you're incapable of your worst month. And that could be like literally every trade you make is bad. What's your average risk per trade, meaning how many pips do you lose per trade? And then from that, ask yourself, what do you want that worst month to be? A 5% month is bad, a negative 5%. A negative 10%, you probably will never raise money. Right? People just don't want that. They don't want a negative 10% year. Why would they want a negative 10% month? You understand? So ask yourself what you want it to be. It's your call. Maybe your clients are different. Maybe there are clients that want risk. I've talked to clients where I give them, the sales pitch that you give an American. Right. I don't work with Americans anymore, but let's say Western world people. And you say, oh, we're very risk averse, which is great. Up until recently, let's say over the last 10 years, up until recently, if you met someone from the Middle East, they're like, how much risk can you take? And you start talking, you're like, well, we're really risk averse. But it's not the sales pitch that they wanted. What they want is, how much more risk can you take? Can you take more risk, please? You're like, what? They're like, yeah, can you triple the count in like a month? Like, well, theoretically, yeah, but you'd be assuming so much risk, it'd be ridiculous. They're like, yeah. Could you do it in 2 weeks? Like, what? Yeah, if I gave you 10 million, how fast can you make 100 million? What? Can you do it now? Can you do it today? Like, yeah, I guess I probably could. I could leverage that sucker to 1,000 to 1 and drop one giant trade on Euro USD and hope it goes, I don't know, down today. And if so, yeah. But I could lose your 10 million in about 25 minutes. But it's funny, right? So KYC, right? Know your customer. If that's what they want, I don't know. That's going to be up to you to decide how to handle that. But ultimately, what you need to think about is what's right for your clients and what is the worst case scenario drawdown. Bear in mind, drawdowns are bad. A 50% drawdown requires a 100% return to get back to zero. And if you're so good, why did you get the 50% drawdown? I mean, no, you're going to get to 100% drawdown before you get back to break even, right? So again, reverse engineer everything. What would you like your worst month to be? Because you're going to have bad months. Every single trade you make goes bad in the month of March. How much did you lose? If you say 5%, for example, so you could recover from that. I think people would look at that and not be too worried about it. So you say, all right, we had a horrific month. It was all bad central banking stuff. It was terrible. Great. Right. You didn't know the yen repatriation stuff. Great. Fine. Okay. 5%. What's the average lot? How many pips is your average loss? 50 pips, 100 pips, right? Calculate how many trades you typically make times your loss per trade gives you the number of pips. Let's say it's 2,000 pips. Then you say, well, 2,000 pips is worth 5% of my account, which will then derive your lot size. And you will be shocked at how small your lot size is. Then you'll say, oh my God, that's what Wade's been saying for 12 years. And I'll say, yeah, you just figured it out. Then you're like, but wait, that means I only make 35 cents a day. All right, fine. If you had $100 million, what would it be? $35,000 a day. So you're just $100 million short, but your trading is still consistent. Well, Hans, okay, so Hans asked, when do you stop trading if you're having a good month? Well, if it's your money, you can do whatever the hell you want. If you're trading other people's money, it's your job to make money every day. There's never enough. And if you go to your client and say, I made 10%, they'll say, why isn't it 20? Right? You're like, oh, they're going to be so happy. I made them so much money. I was such a great trader. Things just went my way. It was all my analysis. Then you go up there, hello, Mr. Client, sir. I made you 10% this month. They're like, why wasn't it 20? Like, aren't you happy? Why? Why should I be happy? Why isn't it 20? Why isn't it 30? Maybe I should fire you. Maybe I should ask for my money back. It's never enough. Your clients are going to hate your guts. If you're good, they're going to hate your guts if you're bad. Especially if you don't know how to work with clients. If you take money from someone that doesn't respect you, then you're just a scumbag. They'll treat you like the same, like someone who shines their shoes or mows their lawn or washes their car. You're the person that trades their money, right? So you got to be careful how you deal with people and how you set up the relationship. But the bottom line is never get too excited. Realize your job every day, every minute of every day is to manage their money and to turn a profit. Okay? Now, does that mean gamble it, make a lot of money? No, because you'll make money this month and they won't care. They'll say 10%, why wasn't it 20%? And then you lose money and there's F you, you're fired. You lose a lot of money, they bury you in the sands somewhere between Dubai and Abu Dhabi. No one ever sees you again. Right? There's the honest truth, right? So your job is to wake up in the morning, make money. And then tomorrow, wake up in the morning, make money. You're up 12% this money? Great. Wake up in the morning, make more money. If you lose, you're fired. You have a bad week, you're fired. You have a bad month, you're fired. You have a bad year, and your kid says, Mama, what's vacation? It's where your daddy goes to the Middle East and never comes back. Right? So that's it. So there's unlimited upside as part of what you're showing people. Unlimited upside. You have 10%, make 11%. You have 11%, make 12%. But don't do it as a function of risk. Lower your risk, lower your risk, lower your risk. Your good months pay for your bad months. Your good months pay for your mediocre months. All this kind of stuff, right? But dear, there's a lot of secrets buried in the desert. Right? So, anyways, yeah. So remind yourself, guys, it's your job. It's never ending. It's relentless. It's 24 hours a day, 7 days a week. None of this 5 days a week nonsense. Because on the weekends you're preparing. So it's always, and you always protect the money. You always reduce risk, and you always make money. Ideally, with very little volatility. So you better like what you do. You better love it. Right? And ideally, when things go well, everybody does kind of love you. They don't love you one-on-one, but they love you with your friends. They're like, hey, here's a Wayne. Come on here, Wayne. Oh, you love this guy. He's very good. He makes me so much money. And then you see him privately. He's like, you need to make me more money. What? I need a bigger boat to make him more money. Right? But when he's all happy, then maybe some of his friends become your clients, right? That's how it goes. Gareth is learning a lot. This is my first day. I don't want to be buried. Yeah. So, anyways, lower your lot size because that'll lower the volatility. When the markets are good, right? The markets are good when your alpha is lined up with the beta. You will produce a higher return. If you produce a high return and it's not lined up with beta, it's because you took on too much risk. And therefore, if you go to your client and say, hey, I made a lot of money, and they measure the beta and they see there's a disconnect, then you risk their money. And even though you made a lot of money, you're fired. Yeah, right on, Ryan. Yeah, you know, it's volatility is one of the things that people look at. Remember a few days ago I said like professional investors don't care about your winning percentage, right? They care about things like volatility, risk-adjusted performance. These are the things, right? If you follow up a plus 10% month with minus 5% month, there's concerns there. That would create a high volatility, right? Because the spread on that's 15%. That's not good, right? That means you have big month, big winning months, big losing months. That's not what people want. Risk-adjusted performance to say is to look at your performance relative to the market or a benchmark or something like that, maybe to a CTA index or some other measure of peer performance, right? Whatever your risk is measured against, right? And if you have a high return, yet the market conditions are not conducive to high returns, then you made it by taking on more leverage, making bigger trades, right? That's what I mean by leverage. You increased your lot size. And people generally, institutional investors in particular, in the Western world in particular, they don't want you to take bigger risks. They just want to say, if I give Ryan money, the end of the year, I will have a predefined amount, right? So if you're an institutional investor, they're like, right, if I give you $100 million, right, I'd like 8% for the year. But I want no volatility, right? But we need to bank on this because we've budgeted on this. Okay? You understand? So that's what they want to say, input, output. If I give you the money, how much will I have at the end of the year because we budget on this stuff? They don't want to see like you're up 40%, down 20, up 50, down 16. It's just like it's way all over the place. And they might have a lot of money today and then it might be all gone tomorrow. Maybe it comes back, maybe it doesn't. Maybe 3 months in a row you bust out the account. Just the stuff they just can't have. So that's why you want low lot sizes relative to the account size, because then even bad months are really not that bad, right? 5% just may not be a lot of money. But what's 5% compounded for the whole year? Charles says over 60%. It's more like 100%. Thank you, Daniel. Compounded. Yeah. So you understand, guys? So what if you spoke to a client and you say, well, you know, what we're trying to do is have steady returns with low volatility, non-correlated to other markets. We're an absolute return fund. So what we're looking for is a 2 to 5% return per month. Okay. And then you can say, well, 5% is basically doubling the account. Now, 5% every month. And so that's very unlikely because some months there's lots of volume and volatility. Those are the months we tend to have higher returns. But then there's some months that just have lower volume, lower volatility. And that's where our competitors typically lose money because they don't adjust for changing market conditions like we do. So those months we just expect to have lower returns, but the volatility remains low. All of a sudden you sound like a genius. Right? So where do I think I'm done, guys. I don't know, I just don't have the energy today. What tool do I use? Ernst & Young. Get it, Hans? Now, one thing that I don't believe my FX book does is the pain to gain ratio. I think it does a lot of other things, right? Sorrentino ratios, Sharpe ratios. There's probably hopefully there's 2 or 3 different Sharpe ratios. But I don't think it does a pain to gain because I don't think MT4 really does that for them because they're just pulling it from MT4, right? So but because for a pain to gain ratio, what you need to look at is, open positions, right? And that's where a lot of people trick unsophisticated investors on these like trading sites, copy sites type stuff. They'll say, look, here's our returns, right? And look at all our winners and all this kind of stuff. But it's not measuring that this guy averages, let's say 25 pips per trade that are winners. Let's say losers are 30 pips. Looks reasonable. But what you don't see is these winners and losers are sometimes down 200 pips. That's why I say, well, if your average winner and loser, let's say, is about 25 pips, okay, I get that. But at what point, like, what is your average drawdown or let's say maximum drawdown? Because it's funny, if you really start to look at trading history from traders, it'll look good. Like I've had traders give me thousands of trades, right? And then I go through them, and I have actually other professionals go through them. They'll say, well, do you realize this one was down like 800 pips? Just one trade a long time ago or a month ago. It doesn't matter. You're like, what? Right? There, right? So that is a problem that most of these sites don't even give you a way to measure because they only record open and close. They don't record what happens in between. So that's why I want to look at open position, open equity drawdown. So they're not on closed trades, they're on open trades. Very often you'll find they'll carry a lot of trades to -2 or 300. But if you didn't know that, eventually they close for a lot smaller, or actually they close for winners. These guys usually that hold -300 are very happy to go, +30 and take the profit. Stuff like that it just doesn't quite show you. It's not quite there. Open equity, not equity drawdown. Equity drawdown, you're talking about the money in the account, but I want to know per trade. But right, and equity drawdown is very often the losing trades subtracted from the amount the money in the account. So you got to be careful. So, like, what if all I did was show you all my winners and I never cashed out on my losing trades? I could say, hey, look, I'm up 45%. But then if I, right? But then if I actually showed you the account, I might be down 45%. Like, dude, you have this huge loss. Yeah, well, I haven't counted that yet. It just it hasn't worked out. It'll work out. You're like, but you told me you're up 45%. I am. See, look at all the closed trades. No. I'm interested in the open trades too. Oh, well, those are just winning strategies that haven't won yet. They're just down severely, you know. So, anyways, you got to be careful. So, for example, one thing I would recommend to a client, but also what I would recommend to a trader, is to go through a class. Are you ready for this? You'd have to be pretty willing to be successful. Go through a class on investor due diligence. Take a class on investor due diligence. Or at least read some books, for crying out loud, right? So imagine now you work for a family office managing a few $1 billion for 3 or 4 families that are extremely wealthy, and you're one of their investment professionals that actually work for them. You represent these families, right? Family office. One of the major components of your job is to sit down with hedge funds, analyze them to see if they have the potential for your consideration for investment. Now you have, a whole portfolio to deal with and different risk tolerances throughout the portfolio and time horizons on liquidity and all this kind of stuff. Great. Now you're thinking, all right, well, we should have some forex in here. So maybe you could, as an allocator, maybe you have like 300 million available out of your 4 billion. Like you want to put 300 million towards that asset class. The risk tolerance is a little higher. Okay, great. So now you have to sit down with currency hedge funds and CTAs that have managed programs, analyze their performance, and look for suitability. What is it that you do? What do you look at? Right? And there are classes you can take, and there are books you can take. And, I think I have one here for you that I could recommend. Way up here. Let's see. Hang on. Is it up in this pile? There it is. Tippy toes for that one. All right. This is Jack Schwager. What is Jack Schwager known for? He wrote all the Market Wizard books. Well, how did No, what? How did? Look, think of the first book. He hadn't written it yet, so how did he, first of all, know who the market wizards were, and then how did he get permission to put them in the book? Before he wrote his first book, what did he do? Take a wild guess. He did due diligence on CTAs. Come on, guys. You gotta. Some of you guys are so Yale. Keep up, man. Keep up. Stick with the program. Come on. Yeah, there's always Yale. All right, so Swigert wrote a book called Managed Trading, Myths and Truths. And this is what he did. He worked for a fund or some sort of organization where he analyzed the trading history of commodity trading advisors and other like hedge funds and stuff for their suitability for investment. Okay. So this one again is managed trading. So just think of that, right? So here's from the foreword. My experience in Wall Street suggests that the financial world is permeated with mythology. Respected financial executives who would scoff at the idea of generating profits from fortune tellers feel that the direction of financial market is, to a great extent, predictable. They often offer their views on future market performance unhesitationally. Oh, it's a hard one to say. Other investment professionals believe that the best way to achieve high returns is through the purchase of undervalued assets. Beyond these myths, however, are facts that present an entirely different picture. As an investor or portfolio manager, you should question these presumptions and consider approaches followed by some of the world's great traders. In doing so, you might gain insights that will influence your interpretation of events occurring in the world's evolving financial markets. While almost everyone on Wall Street has a strong opinion on markets, the fact is no one can predict with consistent accuracy the future direction of markets or of investment returns. People read the phrase, past performance is not necessarily indicative of future results, and assume the opposite. The future is not predictable, and I have yet to meet anyone on Wall Street or off, with or without a computer or doctorate, who accurately predicts future events. Blah, 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 blah. So it's a whole book. The goal of the book is nothing short of shattering widely held but totally erroneous conceptions and beliefs regarding managed trading. Some of the key points demonstrated in the book include why actual performance results may be a misnomer, why many investors in managed futures lose money even when they select a winning commodity trading advisor, why the actual performance of funds and pools invariably falls far short of prospective results, why superior performing money managers in the past cannot be assumed to be more likely to realize relative superior performance in the future, why it is usually better to invest in CTAs when they are experiencing drawdowns as opposed to when they are on winning streaks, why all conventional CTA indexes are misleading, blah, 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 blah. So anyways, that's a whole book on doing due diligence and how to understand performance and how to therefore,
learn how to invest. I mean, I don't know. You got to come at it from all angles. Like, you're the one reviewing your performance. So I guess that's the kind of stuff that I'm going to go through when we're in South Africa at the end of the year. I'll teach you how to do that kind of stuff. Look, analyze returns as an investor should. And the reason you should do that and should know this stuff is so that you can sit down with a potential client and say, let me show you all the stuff you should worry about when you're thinking about investing with me. I just want to make sure you know everything. There's a lot of good, there's some great, but there are some things that I think an informed investor should seriously consider when investing in me, but also within, anybody. And then I'll explain how my performance results are, better than average, and how I achieve that, and how I manage that risk, so that you can sleep at night. Okay, so you got to go in like you're a due diligence team. I once had a guy who asked me to, so I handed him like this huge thing of performance, and they wanted me to go back and recalculate everything on a day-to-day basis going back 3 years. I'm like, well, it's weekly. They're like, yeah, we need it daily. Oh, and by the way, we need it on Monday. I said, well, I suppose that can be done, but I want you to understand that for me to have that on Monday, I need my team, right, to go through tens of thousands of trades, which means they're going to need to work day and night all weekend to have this ready for you on Monday. He's like, yes, great. Yeah, I'm like, good. I just want to make sure. I just want to make sure you understand what you're asking for. Yes, Monday will work. Yeah, there's overtime. But you need to think about what they're asking for and what they're doing, and they're looking for risk. They don't care about the returns like an amateur does. Well, you pay. It's your team, dude. Imagine you sit down with a guy. Hey, will you invest a lot of money with me? Yes. Well, I want you to comprise this document for me. Well, I don't really have a lawyer. I don't have an accountant. I don't have a finance guy. I don't no. I use my FX book. I don't know what any of these numbers mean, but I made a lot of money. It's so funny. It's just so funny, right? I don't know what any of these numbers mean, but it comes. That's what it says. So, yeah, I have a widget on my website, dude. Right? I mean, whatever. So for you, usually when you go in to meet with a sophisticated investor, you should have things like a law firm, right? An accounting firm, a finance team that can generate financial reports for you and stuff, right? You should know what you're talking about. That kind of stuff, right? So anyways, what time is it? Okay, so I've been babbling on again. I'm just tired. I don't feel tired. I'm just not in a mood today. So if you have one more question, let me know. One more question. Yeah, a license. Yeah, license registered somewhere. you know, but, you know, just something. Yeah. Just, you know, just show that you know what you're doing, but, you know. Any last questions? No? You want to just meet up tomorrow? What's your target for the month? A lot of my targets have been hit. Missed it. Yeah, dairy auction. Yeah. So watch the kiwi. What's your target for the month? It depends, but we've hit a lot of them. How do I set it? Use pivots. Any leading indicator will tell you. Like, see this pound Swissy? This double bottom was the projected, conservative projected bottom for the month. So when I did the swing trading course, if I had pulled up the pound Swissy, our conservative target would have been 122.32. Actually, it's 122.33 because it's 122.32.7. So 122.33. It double bottom, but you notice the cluster of weekly and monthly pivots, double bottom right off there. So pound Swissy is already done. We finished that last week. I've already washed my hands for supper. When you're up like, no. Hans, obviously you came in late because we had a whole conversation about that. Your job is to every single day make money. Why would you limit your upside? It doesn't make any sense. I'm afraid I might lose my money back. No, dude, you make money every day. Yeah. You know, and the same thing on the down. Some people will say, well, I lost 5%. I need to stop trading. Why don't you just stop sucking? To make money today. Because your job is to make money. That's, if you trade other people's money, you wake up in the morning, you get them richer. You make your rich clients richer. Right? So if you've had a bad week, good. Why don't you try something new, like stop sucking? Stop making pathetic trades. Get on the clue train. None of this, you know, I need to take a break. I need to go on a 3-day vacation because I've been losing so bad. Why don't you go on a 3-day vacation because you earned it, right? So wake up the money, make up in the morning, make money for your clients. And don't do it at, you know, by risking. Yeah, tough love, right, Rob? But it's like I said, even when you do well, the clients don't care. When you lose money, the clients care and you're fired. And if you made the money, they're like, they thought about firing you all week or all month. Because look, you're up 5%, but then they got some Yahoo cowboy somewhere else doing something stupid with their money that's up 15 or 20%. Took way more risk than you, gambled it on some stupid idea, but the client doesn't know all these things. They don't get it. So they're like, well, my other investments made 15. You only made 10. You're like, but yeah, but the market only, you're like, I captured the full beta without taking giant risks. I mean, this 10% is way better than that 15%. I don't know what you're talking about. All right, so whatever. Just sit down, shut up, do your trades, make money. Don't make stupid trades. Buy at support, sell at resistance. How hard could it possibly be? Right? So like pound Swissy this week. Let me zoom in. 15-minute chart. Right? This is the buy zone. Look, you bought it. You're making money. Great. Great. Yeah, good job, man. Good job. You bought it right in a cluster of weekly and monthly pivots as support, and it went up. Yeah, that's really good. Right? Jam your stop. Move on to another trade. Right? Stop complicating it too, huh? You ever get mad at yourself? Like, why is it so complicated? You need to simplify these things. What's your trade for the week? I don't know. Well, there you go. You're making it complicated. Right? Like buying a double bottom at the weekly central off of buy zone in an uptrend for pound Swissy, it's not that complicated, right? You just had to be there when it happened. Well, how do you know to be there when it happened? Well, what do you do on the weekends? You don't analyze your charts to come up with strategies? That's what a professional would do, right? You should be sitting there like, oh my God, if this double bottom is right around that, boom, I'm long and strong. That's how you do it, right? How much time do you spend on the weekend on your forex, right? There was a guy doing an interview on Masters of Business, and he was a technician. And the guy's just like, yeah, well, oil's, kicking off the support. And, and then the guy asked about something else. And he's like, yeah, well, it's, rolling over at this area. And he says, well, you seem to have a good sense of where all these asset classes are. And he's like, yeah, well, look at the charts. He's like, well, when do you do that? You do it on the weekends. Really? You spend time on the weekends? Yes, several hours. He's like, but I enjoy it. I'd sit down with a cup of coffee and I could just go through my charts that my staff print for me. He's like, well, how many charts do you go through? 1,000. How long have you been doing that? 35 years. Drink a cup of coffee, go through 1,000 charts. You know what I mean? Like, isn't that what professionals do? And he's not complaining about it. Some people wake up in the morning, read the Wall Street Journal, get all that liberal mumbo jumbo, reading pages of other people's opinions and pages of Reuters press releases. Why don't you just read your charts and make decisions? Oh, I like what this pound yen is looking like. Ooh, what if these pivots open in such and such a way on Monday? I think I might be wrong. That's what you need to do, right, guys? Imagine Wall Street Journal came to you and asked you questions about what you think the currency market's going to do. You say, well, you know what? I spent several hours this weekend going through charts. I got 3 really interesting things that I'm preparing for. And all of a sudden, you're the news. Is DeBista here? Where's my buddy DeBista? There he is. DeBista is now featured on television in his country and is now the renowned, right, foreign exchange technical analyst on television. So congratulations, man. Yeah, congratulations. The foremost authority. Yeah, no joke. Yeah. I've known DeBeester for years and years and years. Yeah. Didn't know you were so pretty. No, well, he does the work, right? So I'm just saying, though, isn't that what you're supposed to be doing? Aren't you supposed to be the expert? You want to get rich, right? Well, to get rich, you need assets under management. If you're going to take low risk, you're going to need a lot of money. So how are you going to get a lot of money? Well, I suppose you need to be an expert. People should come to you. Wall Street Journal should come to you. One time I was on vacation. My buddy's like, what do you want to do in the morning? I'm like, Well, at 6:30, I have an interview with Wall Street Journal. I need to take that call. But after that, I got a few hours. You want to go get a coffee? Made boom! Impressive thing to do while you're traveling. Okay? So you need to be the expert. So what do you need to do to be the expert? Do you review 1,000 charts looking for things you should be doing on Monday? The answer is no. Maybe you should be doing these things. Okay, go ahead and post the link to Vista if you have it, and then I'm going to shut down the video. Yeah. Yeah, my Nepalese isn't very strong. Yeah, but I can pick it up like yada, 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 Euro sucks. Yada, 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 ECB sucks. Yeah, 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 Druggy sucks. Yeah, that part. Yada, 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 do less for longer. It's just some of these strategies that these bankers, I'm losing a lot of respect for a lot of these bankers. Or politicians too, right? Like Japan. Yeah, let's do huge amounts of quantitative easing and jack up uh, borrowing costs at the same time. Jack up taxes, sorry. Jack up taxes at the same time. You're like, well, wait, that doesn't make sense. You're trying to increase the economy and decrease the economy at the same time. That's weird. And Draghi's let's do less for longer. What does that mean? Peter, I used to recommend one, and then it just went out of business. You might want to try Forex Tester. I used them years and years and years and years and years and years and years ago, and it wasn't really done. It wasn't created for that. It was created for back testing. So it kind of worked, but it was really complicated to set up. And then it kind of worked okay for that. I know they're probably on Forex Tester 3 or 4 by now. So you might want to try them and see if it's better. But there was one that worked really, really well. And Daniel had a copy, I had a copy, it worked really well. And then I think there was an upgrade to MT4. It stopped working. The guys stopped supporting it, went out of the business, whatever. But it used to be really cool. Well, back testing, like what? What am I back testing? I'm forward looking, not back testing. I mean, I have a strategy and a methodology. It works, right? But do I buy every 5A cross? Do I sell every 5A cross? Do I buy every 2155 cross? Do I sell every touch of the 200? Do I buy every M2, sell every M3? No, no. I make decisions. Right? Yeah, there is a lot of talk about back testing, and I suppose if you're trying to create an EA or a series of EAs to do something for you, that's something that you should do. But what it ends up doing is you start creating things to work in the past and not in the future. So, for example, the market conditions this year are nothing like last year or the year before the year before. So if it worked last year, I honestly don't think it'll work this year. The market conditions are the same. Now, your moving averages might be the same, the pivots might be the same, but like now we're actually want the Fed to raise interest rates. Last year, the Fed said they were going to raise a whole bunch of times, and they didn't. That freaked the market out. And the year before, there was no way in hell the Fed was going to raise interest rates. So it's those things that matter. But so the market conditions are different, right? So what worked 3 years ago is pretty much irrelevant. But I'm not saying no. It's just I don't know. I don't know. I make decisions, and, right? I use my tools, in this case, technical analysis and fundamental analysis, to create an outlook for what I believe is going to happen now, in the near future, and and farther out in the future. And then I start using technical analysis to buy and sell inappropriate moves up and down throughout that scenario at different times of year with different seasonality. And I think a lot of the EAs and stuff, and probably every EA out there, doesn't even incorporate something as simple as seasonality. They buy or sell a combination of moving averages, or buy and sell, oscillators and combinations with this and that and the other thing, but they're not making judgments. Remember, these algorithms only produce what the math tells you to produce. Okay? So if you only buy oversold markets, let's say you program that in, then now another thing you need to program in is to say you need to only buy in oversold markets, but in uptrends. Well, how do you define an uptrend? So now you need a combination of tools to predict whether it's an uptrend, side trend, or downtrend. So then you put that into your EA. All of a sudden, it might work really well 9 times a year. Okay? So I'm not saying don't backtest. Don't walk around and say, Wayne is anti-backtesting and stuff. No, that's not what I'm saying. But what I'm saying is I spend way more time forward-looking than backward-looking. Okay. So anyways, I've gone way too long, guys. So I'm here tomorrow. Why don't we continue the conversation tomorrow? Thank you to Debista Superstar. I thought you'd be taller though, Debista, honestly. I like to say, when I'm on TV, I think the camera adds 25 or 30 pounds of fat to my face. My wife's like, no, I think it was the beer and the wine that added fat to your face. Like, that's rude. All right, take care, guys. Love you. Got a job.